Well, we gapped up and then just rolled over for the rest of the day. In today's stock market brief, we're kind of going to discuss why that is going into 2021, what we should be prepared for. Look, we're still on a risk-on environment. Last video that I posted, I was talking about how I can see risk-off coming in the very near future, as early as January of next year, and I proved out multiple charts as to why it looks like that's going to be taking place. Today is showing some weakness. However, it starts with some strength. So very interesting stuff going on. Let's just go ahead and hop right into the charts. All right, welcome back. I'm going to quickly go through all these charts and then kind of wrap everything up with a conclusion. We'll go over some stock market indicators, some bonds of the dollar. Look, today was a pretty scary looking day. We have a bearish engulfing type candle. We gapped up. That looked pretty positive for the day. However, we reversed pretty much throughout the rest of the day. Now, a couple things to note. We're still above the 5 EMA and this gap window isn't fully closed. Guess what? This was on the 30-minute time frame. What was our target? 37.50 to 37.80. Guess what? We tagged that today and then we basically turned right around after that. We put this on Twitter. We said that the RSI was getting pretty frothy. We talked about that yesterday, and then yes, the rollover took place today. However, we're still, we still haven't filled this gap right below us. We found a little bit of support there, so it's going to be interesting to see how this plays out throughout tomorrow and the rest of the year. But as I see it right now, we're still in a bull channel. We're still above the daily 5 EMA. Everything looks pretty decent so far for the S&P 500. Now, on the NYSE, okay, this broad index, another very weird day, right? We gapped up this day, then what did we do? Well, we fell apart. Then today, we gapped way up, and then we completely fell apart again. But, mind you, where are we? Well, we're on the 20-period moving average, and we're on the 5-period moving average. These are both acting as support right now. When you look at the MACD, this isn't necessarily a, hey, I'm feeling good about this right now and buy this situation. Right now, it is trending down, still above zero, so, things can change. And the Bollinger Bands are tightly contracted, suggesting or foreshadowing a potential very big squeeze here in the very near future. And that squeeze could be to the upside, but it could also, like I said, be to the downside. 20 periods holding, 5-period. Price action is basically sitting on it. NASDAQ is one of the more stronger index for today. It was the only one that finished positive, up $4.63, 0.04%, but it was also a gap up, and then we pretty much closed at yesterday's high. However, we're still within this coiled pattern. This is a rising wedge, okay, and we're still above the 5 EMA. So yeah, it doesn't look like the greatest price action, but take the context into perspective here, all right? So another thing to note, the MFI symmetrical pattern. Look, it doesn't support the breakout here. We're still kind of sinking down. If we start getting below 50, I'd be a little bit more worried. But I like the NASDAQ 100 as a hedge long. If we start pulling down to main areas of support, I would prefer buying into the NASDAQ 100 over some of the other indices. The Dow Jones, look at the Dow Jones has been respecting this upper trend line. We stated this in yesterday's video. I'll talk more on the conclusion. Okay, we gapped up and then we fell apart. Look at where we hit. We touched the lower trend line and the upper trend line. These Bollinger Bands are so tightly contracted. You can see the BB width right down here. Look at how low of a number is printing, 2.032. This type of tightening and contraction foreshadows big moves. Is that going to be to the upside or the downside? I'm not too sure, but you can be ready to play in either direction. Just make sure that it's not a head fake. Now, what I will point out here is the on-balance volume. It's kind of tapering down, so it's not really supporting the drift higher. The pattern itself right here is bearish, but the overall context is still bullish. We're still, right at the pretty much 5 EMA, 30,269, and then we closed at 30,335. So we're above the 5 EMA, above the 20-period moving average. It's going to be interesting to see how this plays out, but I can tell you there will be some big moves coming here in the near future. The IWM is what really had a lot of weakness today over the other indices. So small caps, mid caps, they got hit the hardest. Now, this is the first day that the RSI actually fell below overbought territory. So it has just been grinding higher and higher and higher. Overextended moves can stay overextended for quite some time. Now, we closed below the 5 EMA here. The MACD, you can now really start to see the spread take place. You can see the histogram kind of dipping down, but I want to point out a couple of things here. First off, and I'll show you on the 2-hour time frame in just a second, but the 20 period is still below us. The 20 period moving average can act as a level of support. We haven't tested it for a while, so don't just think it's going to completely fall apart here, and then start shorting before the 20 period, because if you didn't catch this move to the downside, you don't want to this is where you would scale some of the short positions out, and then, and then see if it breaks down further and scale out more. You don't want to sell into an area of support, because you might just bounce from those areas. And I talked about this on my Twitter. If you don't follow me there, you can follow me there. I called this out throughout the day. Look for the dead cat bounce. I marked out support. I marked out resistance on the 30-minute time frame, and it acted perfectly within those areas. Now on the 2-hour time frame, you can just see here, just gap up, showed strength, hanging man candle, completely just fell apart throughout the day, and then we saw some bounce at 193.50. Look at this is important to test. This bounce area right here, we need to test this area. If we don't test this area, we're just putting in a higher low still. So the trend is still up, all right? And we have this gap below us. This low right here on the 2-hour time frame is pretty much exactly where the 20 period is on the daily time frame. So we have a couple of things to watch out for. This right here lines up with the 20 period confluence. SMA could act as support. You have this previous bounce area that should act as support. And then you have this gap right below us that could potentially act as support. So, that's why I'm saying don't sell right now into this. You might get lucky and it might break down. But this is typically, you should have shorted up here on the negative divergence, and you would have scaled out some of the stuff right here. Because if we start getting a rip higher, then you're just really going to be, it's just going to be a very poor execution of a trade right there. So we got to monitor this, keep it close, because we might just bounce from this level, come up a little bit, show some strength, and that might be where we start putting in the lower highs, and then you see a potential breakdown. I posted on Twitter a while ago, this rising wedge, if it breaks down, you see a collapse of it. I said, hey, looking back at this, it's going to be the most obvious thing that we've ever seen, really, that it would fall apart. But we're not quite there yet, but this is, not the worst start so far. Now let's quickly look at some indicators. The VIX, increased volatility today, up $1.38, that's 6.36%. So what did we say, previous market briefs ago? Well, it was contracted. We might see a squeeze. Boom, we saw a squeeze, but it didn't close up there. So the Bollinger Band stayed contracted, very low levels. You can see this. We have to break above 25 to potentially get another, jolt higher. So if we get above 25, I would expect to see more of an aggressive move here. Keep in mind, we're still kind of just drifting down, but we did see some strength today in volatility, all right? This gap still below us is not filled, and this rising wedge pattern is still, falling wedge pattern is still kind of holding. And then you got the RSI. It's not quite above 50, but you can kind of see this little cupping pattern. The last time we found this little cupping pattern was right down here, and then we got that move to the higher, and now we're, a higher low. We're kind of cupping up. Maybe we start getting a little squeeze up to overbought territory, and you see this thing kind of rip higher. It's something to look out for. This week is, a short-term trading week, and there's a bunch of news around the $2,000 stimulus bill. Anything could happen with that, so you just got to be very, just prepared for, either direction. It's just the market moves on these headlines. This is the sell signal. Look at not much going on right here at all quite yet. We are at 0.78. We got to get across above 0.80. That would be the sell signal. So we'll keep an eye on that. NIMO. Okay, if people are wondering, why are we getting these gap ups, but then all these individual stocks keep dropping? Well, it's because of poor breadth. All right, look at minus 26.61. That was actually a pretty nice spike to the downside, but we're not really seeing the market, get hit too hard with this poor breadth. But if you're wondering why your individual stocks are taking some big hits now and then, well, just take this into consideration. The breadth is not that great. At least here on the McClellan oscillator. If you look at the 200, the percent of stocks above the 200 period moving average for the S&P 500, that just fell below 90, which is still a very high number. All right, what else do we got going on? Let's get into bonds really quick. I'm going to go quickly through this. Bonds still holding higher lows, okay? So there's still the potential of this breaking out to the upside. Until we see that break down, well, then bonds are still kind of trending lower because we're putting in lower highs, lower lows. But since November, we're putting in higher highs and technically lower highs. So it's a symmetrical type pattern kind of forming there. Yields, not doing anything today. Look at, didn't even move for the 10-year. The 30-year kind of drifted just a little bit up. And then our spreads are still kind of holding there. So just tightly contracting, staying below zero, still following this trend. It's going to be interesting to see what plays out here. I will say, This very similar type trend on the 10 and the 30 year was happening here in September to about 2020, September 2019. You can see, just follow the black line, low here, higher low, higher low, higher low, higher low. So it trended up. Then you see the 10 year kind of doing the same thing right there. And then when it broke down through that trend, you saw that pretty sharp move to the downside. Not sure you want to use that as your correlation or anything, but just know that, hey, the trend is up, getting rejected at 1. Are we going to see a spike higher? We're going to see maybe potentially a rollover. I don't know yet. All right, let's look at the dollar very quickly. I posted some cool charts on the dollar today and even gold. I'm not going over commodities today. I'm thinking about making a separate video more in detail for commodities. Now, the dollar, once again, pretty brutal day, down 0.36. That's 0.4%. You know, we closed below the 90 handle, still holding this upper trend line right here though. So the falling wedge, we broke out, you know, got rejected by the 20, and now we're kind of drifting lower. So sometimes these things take a second to kind of ramp up, but keep in mind the context here. The context is very bearish. All right, we have the 200 period trending down, 50, 20, all trending downwards. The only thing that we kind of have going for us is, you know, this crossover right here on the MACD, you know, and then the breakout of this falling wedge. Really, that's all. But however, on the weekly time frame, you can really see that we're kind of in this area of support. You got a positive divergence there, a bullish type of pattern. You saw this back over here in 2017 to 2018, then we broke out. So it could be intermediate term bullish, but then the longer trends are showing a little bit bearish. Now, I pointed this out on Twitter on the monthly time frame. This is like a 7 or 8 year trend right here. You can see the dollar kind of just going up, bouncing on these levels, and when it broke down, that's when we really saw gold take off. Now we're looking at, you know, another 8 or 9 year trend right here that just recently got broke. Kind of looks like a head and shoulders. You have a left, head, right there. So we started a breakdown through there. The MACD is pretty bearish. We just crossed below 0. You know, where can this potentially fall to? Or, like I said, on the weekly time frame, we're seeing these rising wedges. Maybe it's bullish. Maybe we go back and test the top portion of this trend line. You know, that put us around 95, 96, 97, which would be a very aggressive move to the upside for the dollar. And then maybe we get rejected, or maybe we continue to go higher. We have to play it as time goes. However, we got to look for support now because we broke down to this pattern. Support would be right around 85 to 87, that kind of zone right in here. That would make sense to me. The 200 period moving average is right around those levels too. Then you have previous, you know, resistance up at these levels too. So that would make some sense to me. All right, so let's just kind of wrap this all together. We went over a lot of charts very quickly. If you want more details, you can watch the previous market brief. But overall, the market is extremely bullish. This is the CPCE. Look, we're pressed down below this 0.45 level. We're sitting at 0.45. You know, very few times, you know, in history, the months closed through those levels. But every time it did, we saw some pretty volatile movements in the very, you know, close near future. So everyone's extremely bullish right now, but you're seeing these gap ups and then the market rolls over. Why is that? You know, well, it's because we're just in resistance. We're in a very tight area of resistance, and we're kind of being driven, you know, back and forth, chopped by all this market stimulus news. We got, you know, vaccine coverage, all these hopes and things going on. We're just kind of drifting higher and higher, but we still have resistance being respected. So support. Resistance all the way through. And then look at the same thing with the IWM. We traded very slightly above this, but now we're kind of getting rejected. It doesn't mean that we can't come up and retest these levels, but we've had some just very powerful moves to the upside without any breathing taking place. You take the same thing, NYSE Composite. Where are we? Well, we're up at a very important area of resistance, and this is going back to all the way to 2006. So, you know, these aren't things that you just want to just forget about and just ignore, okay? If you want to play long, you might as well go long when you get confirmation of breakouts of these patterns to the upside, because these are building areas of resistance. We're seeing some weird weakness take place. We're on negative divergences. So if you're a buy and hold for the long term, okay, you might not care if you're buying right here and then all of a sudden we drop back down to these levels. That might not matter because, you know, eventually we can go back up higher. But you know, if you want to focus on your down capture and you do not want to take huge hits in a portfolio, you need to pay attention to these levels. Same thing goes with the S&P 500. Where are we? Well, we're trading right above this level right here. Negative divergence. So be very careful with these levels, okay? We need to get confirmation, monthly confirmations of a break above it. Then we might just all of a sudden start seeing a squeeze higher, and then we could play it as time continues. As I see it right now, we're still risk on, but right around the corner is a risk off environment, and that could, be pretty brutal for people that are ignoring these type of moves. Why could it be brutal? Let me point this out why it can be brutal, because a lot of people don't understand this. It can be brutal because of the fact when it goes risk off and you start seeing a move, a sharp decline, that's when people start to get scared. And people that do not have plans end up making poor decisions at the wrong time. So for example, if the S&P 500 rolled over to around 3,200, they might not see this little trend line right here, that's a chandelier exit, which could potentially act as a support. And I'm not saying that's going to roll down there, but if they start seeing a sharp decline very fast, they are going to be worried that they're going to lose more money, and most likely that is when we're going to get risk back on triggers and signals. All right. So when they're scared and selling, guess who's buying? The people that were that prepared. So we missed the downdraft, and then all of a sudden we catch the move back up higher. That's just how it works. All right. That's all I got for you on today's market brief. Hopefully everyone's having an excellent Tuesday. I'll see you later.